welcome to another edition of Financial Matters. Today we're going to be talking to Vincent and his financial situation. Good afternoon, Vincent. How are you?
I mean, Dominic. Glad to be here.
Good to be here. What's going on in your life?
Well, a couple things. So, my grandfather just passed away a couple months ago, and in that process, I ended up inheriting about $100,000. All right. Now, I want to save up to buy a home in about a year and a half, but I don't want to put it into the market because with all the volatility, I just couldn't see that money get slashed. So that's why I'm talking to you.
What are your thoughts?
Right now, I'm thinking about putting it into a CD and just holding on to it and getting that 4.25%, 5% yield.
What do they quote you on a 6-month CD? I'm just curious.
6 month, I don't know. 9 month is 5.25 APY.
APR.
Yeah.
Okay, APR. Well, okay, that's interesting. You see that a lot at the banks. 6-month CD, 5.5, 5.25. The problem is that you're not getting 5.25 on your 100 grand over 6 months. The APR is the key, annual percentage yield. You're actually getting half of that. A lot of people think, wow, I'm getting, God, I put something in a bank at 6 months and I'm getting 5.25 on my 100,000. You're thinking, gee, I'm making 5,250. When you're not, you're making half of that. So be careful about that. Devil's in the detail. The other thing is, what do you think a bank does with your CD? What do you think they do with your 100 grand? What do you think they do?
Loan it out?
No, they actually buy T-bills with it. So what happens is your bank takes that 4.25 and puts it in a 1-year T-bill at 5.25. They make that 1%, but they have millions and millions of dollars, so that adds up to a lot of capital. Why not go direct? Why pay retail when you could buy wholesale? My firm is an investment management firm. You could buy T-bills directly through us. We don't charge commission or management fee because we're not managing anything. It's just a courtesy to our clients. What we do is we say, hey, you want to buy a T-bill? You don't want to go to a bank? Here, we'll put it in your account. And we just buy it through the treasury desk, and we're good to go. So, yes, I say there's always a better way than using a bank to secure that money. Now, you want something that's locked up for a year and a half, no more.
Okay.
Is that right?
Yeah.
Is that what you're basically saying?
Yeah.
And you don't really want the market to destroy that. What if I told you there's a way you can actually get the opportunity for the market upside, but if the market goes down, you still have your 100 grand? Is that something that would be exciting to you?
Yeah, exciting. Possible, though?
Well, absolutely possible, because interest rates haven't been as high in 20 plus years. And that creates a very unique opportunity, an opportunity that I have not seen in my career. And that is, I could invest in a T-bill. You can invest 100% of your money in a T-bill. You can just take the present value of the future cash flows. In other words, if it's paying 5%, and you say approximately, I put 95,000 in a T-bill, that 95,000 in 1 year, the interest will grow it back to 100,000, right? So it's like growing back your leg or your arm, right? You put 95, it's worth 100,000 in a year. Well, I could take that 5,000 today and put it in a leveraged stock market instrument, giving you 60-65% of the upside with absolutely no downside. So if the market's up, let's say 20% in the next 12 months, you're going to capture, let's say 60% of that. That's 12%. That's better than 5. But if the market goes down, well, you get your 100 grand back. So over the long term, the market's always a better investment than fixed income. The problem with markets is you get those years where it's down 20 or 30. Last year, the NASDAQ was 30 plus. The S&P was down 20 plus. So that's something you can look at, but definitely don't buy the CD. Go buy a treasury.
Okay.
Direct.
Yeah.
Any other questions?
Yes, actually. So I just got handed a whole life insurance policy. My mom took it out when I was about 10. Said basically it was to cover my cost of death in case any accidents happened to me. But then, she wanted me to take over that premium payment, and I just don't know if I would want to hold on to it, so I wanted to get your thoughts.
What's the cash value?
5,000 thereabouts.
And what's the face value?
25,000.
So if you die, you get 25,000. Right now, there's 5,000 in the account.
Yes.
Whole life insurance is sold as a way you can grow a retirement plan tax-free. I've seen the tax-free 401k. Okay. Insurance to me is not bought, it's sold. And the reason it's sold is because they pay such high competition that nobody would buy insurance if it was totally transparent. The problem with whole life is your internal rate of return, even though they say, oh, you're making so much, 5, 6, 7% on your money, but then you back out the cost of insurance. So you're really not getting a competitive rate on that. Plus you've got the agent to pay, the insurance company's got to make that money, the cost of insurance, all the things are eating at that cash value. And then their argument is, well, you could borrow against it when you're 60, when it's worth $1 million, but then you got to pay interest on your own money to borrow your own money back, which is kind of stupid. I like term insurance and invest the difference. At your age, how old are you?
22.
22, at your age, $1 million term policy is probably pennies on the dollar compared to the whole life policy, which is $25,000.
Wow.
If you really need insurance at 22, you're not married?
No.
Kids? Not that you know of? Okay, so the bottom line is, I would dump the policy. I wouldn't pay in a premium. If you want insurance, go with term. I think your mom was sold something. I think a lot of people are sold when it comes to life insurance or annuities. I would say 99% of life insurance annuities is not worth the paper they're written on. So no, just say no.
Okay.
Dump it.
Now, if I wanted to set something up for retirement, what should I be looking at?
I love the Roth, especially, a lot of people put money in a traditional IRA. You're under 50, so you can put $6,500 in a yearly IRA. Well, if you did a traditional and you're not making over the limits, you basically could take $6,500 right off your W-2. So that reduces your taxable income. But I like the Roth, and the reason I like the Roth is it's not tax deductible, but it grows tax, not deferred, tax-free. So the problem with the traditional is if you have $1 million in your traditional IRA when you're 65, and you start drawing on that money, it's fully taxable, ordinary income, not long-term capital gains, at the bracket you're in. And if brackets are higher because of deficits in the future, you're kind of screwed. Whereas a Roth, you could have $1 million in your Roth because it grows tax-free and you could take it out tax-free. That's a beautiful thing. I think the Roth is too good to be true, so I'm a big fan of the Roth IRA. Take advantage, try to max out that $6,500. Put it in, you're young, so you put it in a market instrument, and I think you're good to go on that.
Cool. Well, thanks for taking the time, Dominic.
It's always a pleasure.
Likewise.
Thank you. Thank you for another edition of Financial Matters. Talk to you next time.